Ajay Argal, head of India Equities with Baring Asset Management, joins us live from Hong Kong. Ajay, morning. Thank you for joining us. How would you characterize the current market environment for Indian markets and risk versus reward? How are you positioned?
Yeah, it's good that you mentioned it's risk versus reward. We are positive on the Indian markets, and the reason being that the risk-reward ratio we find very favorable. So when I say that, it means that we don't see much of a downside from these levels, because we think that a lot of pessimism is already built into the stock prices. Whereas any small positive news, whether it is on the local front or the global front, can take the markets a bit up. So the growth rates of India still remain much higher than rest of the world, though it is definitely come down a bit in the last few quarters. But still the growth remains higher, and at the same time the markets are now trading at reasonable valuations lower than the last 10 or 15-year averages. So which means that upside possibilities are a bit more as compared to the downside possibilities, and that's why from a risk-reward perspective we are reasonably positive on the Indian markets.
Ajay, come tomorrow and the central bank is going to come out with its verdict on policy action. A, what is your expectation? And B, what is it that you're expecting the RBI is going to do to tackle the liquidity situation?
Right. So taking about the monetary policy first, the RBI is looking at a few things. Obviously looks at the industrial activity, where the IIP numbers are a bit volatile, but also looks at the PMIs, and the PMIs have softened a bit. More importantly, the RBI looks at the inflation numbers, and within the inflation, what is the core inflation figure. The core inflation figure did come down in the last print, and it is expected to come down even further when the numbers are reported later today. With core inflation remaining softer and also the index of industrial production being on the soft side, there is a good likelihood of RBI starting the rate cutting cycle tomorrow with maybe a 25 basis points cut. And in terms of the monetary policy and the liquidity situation, it's again what the RBI wants. So RBI has stated clearly that it wants the liquidity deficit to be within 1% of the net demand and time liabilities. Obviously it's been a bit more in the last few months or so, but it's kind of easing a bit. So I'm not too positive that maybe RBI will cut the CRR as well, and maybe they will keep the CRR cut for later meetings.
Ajay, do you worry about the course of Q4 earnings? Because Infosys Technologies clearly has indicated that they will grow at a run rate which will be lower than the industry average. Most of the consumer companies, they've gone on record and they've indicated that yes, for them demand is taking a hit, and most of the bank managers have admitted that NPAs could still be a struggle.
Right. In terms of the growth expectations, the point to note is the expectations are not very high. So for this quarter itself, nobody is actually expecting for the market as a whole to have a double-digit growth. So people are expecting the growth rates to be in the single digits. So from those levels, we don't find that it could be a challenge to meet them. And as we go forward, there is a possibility that gradually the margins would improve. The margin improvement actually would be visible even in this quarter. And as we get more in towards FY14, it is also a possibility that the top line improves. And if the top line improves and the margin improves slightly, then we could easily have solid double-digit growth, maybe not in FY13, but definitely in FY14. So which means from that perspective, the markets are reasonably valued when we are trading at 13.5 times. So yes, the growth expectations are lower, but it is also, you have to see what the entry point are in terms of the stock prices which is being quoted currently. And from that perspective, as I mentioned at the beginning, we find the risk reward very favorable.
So Ajay, given the kind of risk parameters that the market is having to deal with right now, both on the global as well as the domestic front, what's the upside or the downside that you would, slap for the Nifty?
The upside or downside, and especially in the short term, is very difficult to predict. I don't think anyone can do it on a consistent basis. But what we are more focused on is take a 2-year, 3-year, 5-year view, and from that perspective, the relative growth of India still looks higher, and which means that if we have even a 6.5% kind of GDP growth, which will be translating into a nominal GDP of around 13-14%, which could be the top line growth for the companies. And with some margin improvement, because the margins are very subdued for the last few quarters, we can easily have 17-18% kind of profit growth. And if that is the kind of profit growth, and if the valuations are reasonable, even if we leave aside re-rating of the market as a whole, there is a possibility that we get 15-20% returns from the market over a longer period of time. What happens in the short term obviously is a lot dependent on the global liquidity situation as well, and that is something which is very difficult to predict.
Ajay, I read your strategy report over the weekend. The strategy report also mentions your current portfolio composition, and if I look at your current portfolio composition, you're bullish on banks, but within that you're extremely bullish on private banks, especially a name like HDFC Bank. What makes you bullish on private banks? I mean, they are trading at price to book of 3 times, 3.5 times, even 4 times.
See, one is definitely they are trading at the valuations you are mentioning, but you have to see in relation to where they have traded historically, and we find that the valuations are still lower compared to what they used to trade historically. And the reason for that is the street is very pessimistic on the asset quality, more so on the public sector banks, but it does cascade into the asset quality concerns for the private sector banks as well. And if you talk about a bank like HDFC Bank, it has consistently delivered on all the parameters, whether you look at growth or whether you look at asset quality, and that's why we remain positive there. And even in other private sector banks, we find a lot of opportunities because we think that the margins are stabilizing or improving. Asset quality is not a concern for them. But apart from the private sector banks, we are even positive on the public sector banks, and maybe the public sector non-bank finance companies like Power Finance or REC, where they are more geared towards the infrastructure, and there the markets have been very pessimistic on the asset quality, whereas we think that the reality is not so bad as the stock prices are reflecting for those stocks.
Ajay, what are the pockets that you're completely going to avoid?
It is not that we want to avoid completely something, but at the moment we are not comfortable with the real estate sector, simply because we find that it's better to play the interest rate sensitives through the banking sector, because there is more comfort on the quality, more comfort on the balance sheet. For the real estate sector, the balance sheets are still leveraged by and large, and by and large, except 1 or 2 companies, the real estate companies are not executing on their prime business, which is to build houses at an affordable price. So the prices are still being maintained at very high levels, and at those prices the demand is not so much there, and even when the demand is there, they are not able to actually build and execute and deliver the housing units on time. So we would, we are avoiding the real estate sector at the moment.
Ajay, what Infosys indicated or guided on Friday, do you think that is a company-specific issue, or now that is a sector-specific issue?
I think it's a mix of both. Definitely there has been a few company-specific issues, which is what the company mentioned in their conference call, that some of the clients actually did delay or cancel the projects, especially in the BFSI vertical. But some of the issues could be also industry-wide in terms of what's happening to the visas, and the visas are getting more and more difficult to get by, and also there has been a few cancellation of visas, so which means that the growth could be a bit challenging for the sector as a whole, and the valuations were not giving comfort, and that was the reason going into the result seasons we were underweight on the IT sector.
Will you be a buyer in Infosys? It's at 2400 now, sub 2400 rupees. It has already corrected about 12% in last 2 days, 22% in last 1 year, 19% in last 40 weeks.
Yeah, definitely we don't think that there could be a significant downside from these levels, but still there could be some downside. But more importantly, till the next quarter results, we won't find out whether the guidance has been conservative or it has been actual. So it's better to wait rather than venture into the stock right now, because we are finding the entire market, the valuations are so attractive that the opportunities in the other sectors are much more attractive.
Ajay, what about the GAR guidelines? Do you think for the FII community it's still a grey area and some more clarity is required?
Yeah, I think it is still a grey area, though I'm not an expert and my operational guys would be in a better position to answer that, but I think that's still a grey area.
Ajay, still, since Baring AMC is a product, or it is a AMC which is largely catering to offshore investors, what are the sound bites you're picking up from some of your offshore clients? So far this calendar year, have you got inflows or outflows?
It's been a mix of everything. So one is also you need to figure out, even in some of our other funds where we have India exposure, we were underweight most of the last year, and to that extent we are changing our position from underweight to more towards the neutral, or in some cases we have even gone overweight on India. So that definitely has been the change, because last year the correction was very severe and we thought that it is too much pessimism in the stock prices and it is a good entry point. And as far as the retail interest is concerned, it's a bit low, not only for India but also for all the regional products. And there obviously, just like investors in India are worried, investors here in the region are worried as well as to what is happening globally, and especially with regards to the sovereign concerns in some of the European peripheral economies. So everyone is on a wait and watch mode, but definitely just like the issues which we have in India, there are issues almost in every country. So you need to do a relative comparison while arriving at whether a particular market is looking attractive or not. And even from that perspective, we find that India is looking attractive definitely as some percentage of investments for any retail investor which should go into that country.
So for FY13, is one better off parking money in consumer names which are expensive but businesses are stable, or is one better off buying rate sensitives and infrastructure stocks which are looking cheap but the business cycle in the near term could remain volatile?
Our bias is obviously towards the latter, and I already explained why we are positive on the interest rate sensitives. As far as the FMCGs are concerned, I think you yourself mentioned at the beginning that even the consumer companies are mentioning that they are facing a demand slowdown, and from their perspective there is hardly any room for disappointment, because the valuations are very, very expensive. So some of the consumer staples and the MNC companies are in fact trading 30 or 35 times price to earnings multiple. So we are not comfortable owning stocks in a major way. Obviously you need to own some of it because it's part of all the benchmark indices as well, and obviously they are very good companies, there is no doubt on that. But there is only so much you can pay as a price for that kind of growth, and also when there is concerns on growth. So we are underweight on consumer staples, and we are positive on the interest rate sensitives, because we find the risk reward more favorable in interest rate sensitives at this point in time.
What about PSU stocks, given the way how things have, or Government of India is now treating minority shareholders, first ONGC, then it was Coal India, now IGL. Are you avoiding PSU stocks, or do you think there is, or you want to be a contra buyer there?
No, not really. I mean, we don't look at stocks from a PSU or non-PSU angle. We are looking at what those particular stocks, their businesses are, which sectors they are in, and what are the sectoral headwinds, and obviously the specific issues with the particular stock. So as I mentioned, some of the public sector stocks like a PFC or REC we are owning, or even a bank like State Bank of India we are definitely owning. So we are looking at the PSU stocks not from a PSU angle, but from a stock to stock basis.